This conference will now be recorded.
Good morning, everybody, and thank you for showing up on a Friday, on a busy Friday, with so much happening. I'm going to call the Connecticut Green Bank Board of Directors meeting to order on March 17th, 2023 at 9:03 a.m. So hello. First item is public comments. Do we hear any public comments? Oh, hearing none. Let's go to the consent agenda.
Great. Chair Reed, if I could ask for a recommendation before the consent agenda to move some agenda items around. We would like to move agenda items 4C and 4D involving fuel cell energy before 4A. So wanted to see if we can make that change to the agenda.
Sounds like an excellent idea. Do we need Brian Farnan to rule on that?
I just need a motion to approve the resolution and then, or excuse me, approve that change in the agenda, and then we'll move forward with it.
Okay, so
I'll make a motion to take the items out of order as mentioned.
Second, John Harity.
okay.
Great. Thank you. Okay, so we have two items on today's consent agenda. We have the meeting minutes from our last meeting on January 20th, and then we have one transaction in our under 500,000 and no more than $1 million in approvals to clear the queue. And then we've got several report outs. We've got a report out for our restructured transactions. This is just a report out. We don't have any transactions there in the under 100 and no more than 500,000 in aggregate. We also provided the abridged and detailed financial reports for Q2 of FY23, and then an inclusive prosperity capital report for Q2 of FY23 progress. So the last three items are just report outs. The first two are consent agenda items, resolutions number 1 and number 2.
Okay, do I hear a motion to approve the consent agenda?
So moved. It's Vicky.
Thanks, Vicky. Do I hear a second?
Second, Adrian.
Thank you, Adrian. All in favor?
Aye.
Opposed? Okay.
Lonnie, it's Bettina. I'm going to abstain.
You're going to
because
abstain? Okay.
Yeah, because I wasn't at the minutes, the meeting.
So Bettina is abstaining. So moving on, so we will take agenda item 4C. And I believe we have fuel cell energy with us, correct?
That's right. We'll turn it over to Bert Hunter to introduce the fuel cell energy team with us and these transactions.
Okay.
Yes.
Good morning, Bert. Good
morning, Madam Chair. Good morning to the rest of the board. I believe we have with us, I see him on the screen, Tom Gelston, who's the Director of Investor Relations. He wears a few other hats at FCE as well. And we also have FCE's Chief Financial Officer, Mike Bishop, who's on the screen as well. I wanted to have them present for these two proposals that are coming before the board in case there were some particular issues related to fuel cell energies, either financial statements in detail that I might not readily have at hand, or about future plans for fuel cell energy that they are certainly more than able to address. So the two transactions, I'll just hit it at the top in terms of a summary. The one before you is well familiar to you, which is the Groton facility for the U.S. Navy submarine base in New London / Groton, and we also have a recapitalization facility that we will discuss after this item. That will be item 4D. So let's go to the next slide, please, and I'll just refresh the board on the project. 7.4 megawatt fuel cell that is at New London, Groton, at the Navy submarine base, as I mentioned. It has been operating since September of last year, in fact, and it achieved its commercial operation date in a formal sense in December with a sign-off from the Navy and the utility CMEC. So the objective of that project is to provide for resiliency for the submarine base. It's the entire sub-base systems are being connected via microgrid so that should CMEC go offline, which happens on occasion, then the base will be islanded and the fuel cell, which will be operating 24/7, 365, will provide at least, I think when I read the DEEP grant application, 50% of energy for the base. So very, not only is it really needed for this base, is you're probably well aware, it's for the nuclear submarines that provide for part of our strategic defense, part of the nuclear triad. But this could also be a prototype for other installations at bases around the country and even abroad. So this has got far-reaching implications and is very important, which is why Fuel Cell has been at this, has stuck with this project for the years it has come before this board, and even before it came before this board. So the project cost is 57 million, 66 million, including initial reserves and closing costs. There is a 20-year PPA in place with CMEC. Produces Class 1 RECs, which is part of the revenue stream. Tax equity is being provided by East West Bank. I spoke to East West Bank yesterday, in fact, on a totally unrelated matter, and the relationship officer I spoke with happened to say that he was very delighted that this project is moving forward, and is very pleased that the Green Bank, as well as the other lenders, are providing capital to this facility. So that's good to hear. Senior loan, speaking of those, $12 million from Amalgamated Bank and Liberty Bank, shared equally. And Green Bank exposure is $8 million firm. That there is a potential for us to go up by up to $2 million. And the reason for this shift, which is why this is not a mere extension, which has happened in the past, but a slight modification, is because the fuel cells are currently, due to a technical issue that was identified, an operational issue that was identified during commissioning, is operating at a consistent 6 megawatts of capacity instead of its rated output of 7.4. That increase, or that delta to get back to the 7.4, is the subject of an engineering study that we reviewed and all the parties are pleased with, that will have says there's every reason to believe that full capacity will be achieved in the timeline that's expected, which is by the end of this calendar year, or certainly by the first quarter of next year. If that's the case, the banks have the option. They're trying to work out the specific numbers. It's not expected to be very much, but keep the coverage ratios within limits so that they don't trip. They might advance approximately $1 million less between them. We're just making it $2 million just for an abundance of safety, so we don't run into any hitches. And then what would happen is once capacity, full capacity, or anywhere in between, quite frankly, the banks would advance whatever is indicated by that additional capacity. We would get paid out with that additional advance, and then we would move on as we anticipated originally. Could we go to the next slide, please? So this will show you on there basically two parts of this. On the left, you will see what was approved by the board previously, and what we're bringing to you now is on the right, substantially unchanged except for the budget costs as well as what I just mentioned, with the fact that the Green Bank may advance up to a little bit more of $2 million to take any shortfall that comes from the senior lenders. We remain interest only for the first 7 years, which was previously approved by the board. There is a potential in our interest rate, which is currently set at 8% because we're subordinated, with the expected rate on the senior being 6 3/4 under current market conditions, which seem to be changing daily, by the way. But it almost in a good way for FCE. It's actually coming down a bit. But in any case, we're currently at 8%. We might shift to a floating rate over an index, but or over the senior loan, which is 75, could be 75 fixed, 25% floating, which is kind of typical for project finance type of transactions to give a little optionality on interest rates. But that I don't believe, and I'll ask Tom Gelston. I don't think that was that inked in the final approved term sheet, or did they just go with the spread over the home loan bank term rate? Are you aware of that?
I'm not exactly sure where we finally landed. I can double check that while we're on this call.
Okay. Or I'll ask Mariana or David. I think you're on the line. Was that locked down yet?
It has
I think
not
we were
been
still
locked down yet.
Okay. All right. So that's still open for some negotiation right now. So, but that's the possible range. We're forecasting that the Green Bank repayment, even though it is nominally for 20 years with the cash flow sweep that is in place, we have modeled this to be repaid out in 15 years. And those are the financial parameters. Structurally, on the next page, this just shows the relationship with fuel cell energy at the top. There is a partnership that is being established for the purposes of the financing. You'll see East-West Bank there next to the pale green rectangle. This is a typical structure so that East-West Bank can utilize the tax benefits associated with the project, and Fuel Cell, being the sponsor, would own the balance of the interest. And Liberty Bank, Amalgamated, and ourselves, we finance this through a typical back leverage structure, which is very common, and the board has approved these structures before. We have had them in our a number of the lease structures that we have brought before the board, and so this and most recently the Posigen structure uses the same type of partnership for the allocation of tax benefits. Next page. In terms of risk mitigation, as I mentioned, the plant is up and operating, so there is no construction risk. We are subordinated to the senior loans. The overall debt service coverage trip lines are at 110 of cash flow available for debt service, with the seniors trip being at 1.20. The module reserve O&M payments. So the O&M is broken down into a set aside for reserves for replacing the fuel cell modules that happen every 7 years. And there is a balance that goes to FCE for managing that facility. FCE will subordinate that to provide for additional coverage if there is a need to provide cash flow support, although none is anticipated, but that does help the debt service coverage ratio. So if you look at all of those, as well as a rec floor of $10 per rec, which is for added assurance that because we are looking at a rec revenue stream, we just want to make sure that there is some revenue there. We've modeled this so that with all of those being considered, our loan does get repaid in 15 years, and with those benefits, the debt service coverage ratio comes in about 1.4 times over the entire 15-year period on average. So we're well above the covenant trips for that we've agreed in the term sheet. And let's see, there's significant equity here by FCE, about $40 million, including almost $9 million in reserves. So it just really shows how committed FCE is to this project, which is very good to see. And they're also providing an O&M agreement, as I mentioned above, for the full 20 years. And the off-taker is CMEC, and they're rated AA- by Fitch. There is no fuel risk here. That is being borne by CMEC. So we don't have to concern ourselves with fluctuations in the gas commodity market. So let's leave this up on the screen. And
Hello?
Madam Chair, I'll turn it back to you for
Hola,
any
Paquito,
questions
¿tienen
from the
una
board.
junta?
Does anybody have any questions or observations?
Gracias, perdón.
I'm hearing.
Hi, this is John Harity. I'm wondering how much carbon does this save in relation to if the power was off of the grid?
Yeah, so this is Tom Gelston with Fuel Cell Energy. We generally say that we emit about half the amount of carbon dioxide that the average grid does, and CMEC being fairly reflective of that standard grid aspect. So it would be about a half reduction of the carbon emission footprint.
And is there any prospect of going to green hydrogen on this project at any point?
It's always an option. Right now, it's being fed by pipeline natural gas. We do have the ability to run off of multiple types of fuels, including direct biogas. So if that becomes available, we certainly could easily integrate that into the site.
Thank you.
Mm-hmm.
Any other questions or observations? Has Tom, Lonnie, just wanted to ask, has this led to any other projects with the U.S. Navy or the U.S. military for your company?
As of now, no. I know that there's been a couple that have been discussed about. This is really the first installation, so I do think there's quite a few eyes looking at this. Sort of base resiliency, as well as cleaning up the carbon footprint and greening their infrastructure, is of top priority in the Navy. So I know there's at least one other base that's looking at this as a potential avenue that they'd want to pursue. But I think getting this up, operating, and proven was the first step sort of in sort of that marketing campaign.
Thank you.
Mm-hmm.
So should we move on to approving the resolution number 5? Do I hear a motion to approve resolution number 5?
So moved, Adrian.
Thanks, Adrienne. Do we hear a second?
This is Dominic. I'll second.
Thank you, Dominic. All in favor?
Aye.
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 Opposed? Abstaining?
This is
Lonnie,
Vicky. I'm gonna abstain. Sorry.
Vicky's abstaining,
Yep.
and Lonnie, this is Matt. I'm abstaining as well for the
and
reason
Matt's,
prior.
oh, you're here. Oh, hi, Matt.
Hello.
Good to have you. So
Lenny,
Matt's
happy
also abstaining.
day.
Yeah, Shipment and Goodwin are representing the senior lenders.
Yeah, that makes good sense. Okay. So we move on to agenda item. Is anybody else about to ask a question? I thought I heard some vocalization out there. Moving on to agenda item 4D, investment updates and recommendations.
Sure. This is a recapitalization. We can go to the next slide. So from the last presentation, you were shown how much equity FCE has committed to that one project, and now we're able to recover, and we're able to recover funds from Liberty, Amalgamated, and Green Bank financing. They're able to get the financing is providing $20 million in debt against that project. So the proposal that we're now turning to is a similar concept, but multiplied by 6 projects, 3 of which are in Connecticut. That's 68% of the capacity that's being considered here. FCE has focused for several years to get projects built to demonstrate the reliability of the fuel cell fleet. And now with that done, they're seeking to recapitalize those projects and recover some of the considerable money that they have invested in these projects. Nearly all the production of fuel cells currently takes place in Torrington. In fact, Tom, how is it currently all production of fuel cells are taking place in Torrington at the present time?
All production of our commercial carbonate-based fuel cell platforms are made in Torrington, Connecticut, correct?
Great. So to recapitalize these projects, Fuel Cell hired Investec Bank to structure the proposal, and several banks that are known to FCE as well as ourselves are considering the proposal, including Liberty Bank and Amalgamated, who are financing the Groton project, as well as Berkshire Bank. The president of the Southern Connecticut region is well known to us. He was a former a senior executive at Webster Bank, where we did several transactions with them. So we made those introductions, and they're considering the project as well, or this recapitalization also. So in summary, what you have on the screen is that this would raise be a $93.7 million facility, split between a term loan portion as well as a letter of credit facility for support. The facilities recapitalized more than 32 megawatts of 6 baseload fuel cell projects. 3 are in Connecticut. We'll go through the actual portfolio in a moment. And our proposed participation is $10 million. And it's important to appreciate in that $10 million, this is only a $2 million increase for the Green Bank from where we are right now. We have financing that is supported by the Bridgeport project, which totals $8 million that's outstanding. That's down. It has amortized down from about $11 million when we started. Currently outstanding $8 million, and that $8 million will be totally paid off as a result of this recapitalization. So we're looking at it this way, that we are exchanging a subordinated interest in the Bridgeport facility only, putting up $2 million and rising to senior level alongside on a pari passu basis with the other banks that will participate. And so this diversifies our risk as well as maintains our support for fuel cell and a major employer in the state of Connecticut. So these projects all have fully contracted PPAs, which more than 95% is to investment grade off-takers like Eversource, Pfizer, and the city of Riverside, California, all investment grade, as well as others in the portfolio. Next slide, please. Here's a simplified organization chart. Not all of the entities of FCE are represented here. That would make Mike Bishop's life a lot easier if it were just this simple. But this is just focusing on the entities that are involved in this recapitalization. And so you see where the funding is going to come in at the fuel cell energy OpCo Finance 1 level, and that is a sponsor member of the Long Island Power Authority project at Yaphank, where there is a tax equity participant in that transaction. And then you see the other facilities down below with the Connecticut projects being highlighted, and you see the how substantial those projects are in relation to the entire portfolio. Next slide, please. Here's the full scope of all those projects in detail, which was presented in the memorandum that was circulated to the board. It gives a breakout by the types of fuel cells. They're all consistent across the portfolio, and it does identify all of the off-takers. You see their off-taker rating, and all of them have investment grade rating except for CCSU, which is not rated, but we have financed the Connecticut state systems before and have been quite comfortable with them, and their repayment history is flawless. I believe that Tom or Mike, I think that is the one PPA that actually has been renewed in this portfolio. If you want to speak to that for a moment.
Yes, that's correct. That project has operated for about 11 years now. So we renewed it, I think, about a year or so ago.
Right, and I think that that's also scheduled for a change out, a restack in its fuel cell.
That's happening right now, as a matter of fact.
Okay, great. All right, so that's the portfolio in detail. So we've got a long ways to go for these PPAs out into the 2030s. Next slide, please. Here's a summary of the terms and conditions. You see there that I'll focus on the purposes here. Really is to return funds back to the sponsor. The estimate by Investec is that fuel cell will be able to derive about 50 million or so as a result of this recapitalization. That's net of the reserves that are being set aside. So this is really between the Groton facility as well as this facility, more than $60 million being returned to fuel cell energy, which will go really help their liquidity, which is substantial in any case. It's in excess of it's around 400 million, I think, at this point, Mike, isn't it? As of I think the January numbers.
That's correct. We reported results last week, and we had over 400 million in total cash on the balance sheet.
Great. The interest rate is the secured overnight funding rate of plus 2.5%. That does step up by 0.5% after the fourth year, and there's a front-end fee of 1.5%. Target closing is close, April 2023, and the financing is to a 17-year term to a 7-year balloon payment, which is 46%, And so the expectation is that will be refinanced after 7 years. If it doesn't refinance for whatever reason, then there's enough cash to pay out by having all the cash in the system go to pay down the facility, and that would take 4.5 additional years. So worst case scenario, we're looking at an 11.5 year payback. The debt sizing is to a 1.30 debt service coverage ratio, and the interest rate has to be 75% swapped to fixed rate within 30 days of financial close, which I mentioned in the previous presentation is the option that might be considered for Groton. And there are reserves that are set aside for module replacements as well as a 6-month debt service reserve. Our legal counsel will be Norton Rose Fulbright. All the lenders will be represented by one counsel. Next page, please. And that brings us to the end. So why don't we back up one slide and leave it on the terms and conditions. And Madam Chair, I'll turn it back to you so we can open it up to the floor for any questions.
No, thank you. So are there any questions or observations or concerns?
Hi, this is John Harity. Does this mean that these jobs are going to stick around for a while in Torrington, or?
This is Mike. Yes, I'll take that one. Yeah, absolutely. We are committed to Connecticut. We have our manufacturing facility in Torrington, Connecticut. As you saw on Bert's presentation, these assets are all 20-year assets. So as modules come up for replacement, we will do the manufacturing for these right here in the state of Connecticut.
Are there, Bert, are there any provisions in the loan that if that's not the case, that we get repayment sooner, or there's any penalty?
No, there isn't any workforce provision in the agreement. No, John, there isn't. There's just the expectation that yeah, Fuel Cell Energy has made Connecticut its home. There are 2 other facilities, and maybe either Tom or Mike could speak to that. But I think we have to look at this more holistically, meaning that with operations in Canada, and I think there's one in Germany, fuel cell, this all benefits fuel cell here in Connecticut, because the more that is sold abroad, certainly that redounds to the benefit of their U.S. operations. But Mike and Tom could speak maybe a little bit more to that.
Sure. Mike, you want to go first, or?
Go ahead, Tom.
All right. So, Bert, I appreciate that setup. Yeah, we've been a company based in Connecticut since 1969. We have somewhere in the neighborhood of about 520 team members globally today. The vast majority of them are actually in Connecticut, split between both our Danbury location and our Torrington location. We've been pretty public that we're actually investing more dollars into our Torrington location in terms of capability. And I think right now as an organization, we have posted about 80 open jobs. Again, the vast majority of those would actually be Connecticut-based jobs. We're looking to expand the manufacturing in Torrington, actually. Mike, I don't know if you have anything to add on top of that.
Good summary there, Tom. The other thing that I would say is the company does have an outstanding loan with the state of Connecticut that does have a requirement that we retain presence in the state of Connecticut while that loan is outstanding, and that's a long-term loan. So, and I would reiterate what Tom said, we are completely committed to Connecticut.
Okay, this is Lonnie. Just building on what John was asking, and I know you had some transportation issues getting employees to and from the Torrington plant. Have you been able to improve the accessibility?
I'd say in general, the hiring labor right now is challenging. We have been looking for different ways and working with state agencies and local universities and others to attract talent. into Torrington, into our manufacturing facility. Transportation is one item that we have explored, but we have not put in place a specific solution for that as of yet. We're kind of polling team members, seeing if it would make sense for the company to implement some type of transportation program for our employees.
Yeah, and to add on top of that too, Mike did point out that we're working with local universities and trade schools to try to get growing interest in coming into sort of the advanced manufacturing we have. We also just recently increased our starting wage. So if you go to work in our Torrington facility on the shop floor, you're starting at $20 an hour.
Thank you. Anybody else have any more questions?
I have some questions. It's Vicky. So a couple things. Following up on the earlier questions, since there is this strong stated commitment to Connecticut, would there be any harm in adding a provision, preserving jobs in Connecticut to this? Is my first question. And I guess I'm wondering, how many of these projects were selected through a deep procurement? I'm sorry, if maybe we could scroll back to the project list.
Well, Bridgeport was a Project 150, so that was a different program that was brought forward. I believe Pfizer was just a commercial, straight up commercial transaction. And I'm not sure about CCSU. I believe that was a special program. Mike, do you?
CCSU, there was a state grant related to that project when it initially was constructed, but it was not under, I don't think it was under a broad procurement program.
It wasn't in through an RFP?
It was, if I had to guess, it was this, forgive me, this is Brian Garcia. It was the on-site distributed generation program of our predecessor, the Connecticut Clean Energy Fund, that would have been a programmatic RFP.
Okay.
I don't know, Matt Rinelli, this may stretch you a bit if you recall it, but I think this was a Dale Hedman OSDG project.
Hey, Brian.
So, go ahead.
Yeah, sorry. I think you're correct. Exactly. Back when there were incentives. I mean, flat incentives.
Okay, thanks. And so, but these are subject to power purchase agreements. So I guess I'm wondering, has the Green Bank entered into transactions like this with other companies that are in power purchase agreements with the utilities? Is this something like, can you explain other or provide other examples that are similar to this?
Where we're financing, I guess the clearest example we can cite where we're financing with utility involvement is against ZREC contracts and LREC contracts. That's the clearest example I can offer to you.
Bert, isn't the off-taker for Colebrook also the utility? Or Wind Colebrook?
Yes, that's correct. Colebrook is as well. Colebrook Wind.
I guess I'm wondering about other instances where you've done a refinance for folks who are under a power purchase agreement.
Well, I mean, if you look broadly, for example, and we'll be discussing that actually very shortly. If you look at the Posigen transaction, where that's a refinancing, but it's not involving a PPA with a utility, but it's backed by residential PPAs, and there are refinancings there. So we've been involved in those kinds of transactions. Is your question more to the utility content, or is it with or is it with the nature of a refinancing more generally?
I think it strikes me as a somewhat unusual project. So and that's why I'm asking. I may be wrong. So.
Well, as I indicated in the introduction, we're viewing this as continued support for FCE projects, but diversifying our risk, a risk that we currently have in the Bridgeport project, which is represented by the first column on this screen, and adding 2 additional Connecticut projects in diversifying out of that subordinated position in that transaction and rising to a senior position across all of these revenue streams. So from a risk perspective, as well as balancing that out with support, we see that as a preferred position to be in.
This is Brian Farnan. Can you hear me okay?
Yes, you're coming through loud and clear.
Oh, just one clarification on the lenders legal. Norton Rose is the senior lenders, just to clarify. Our lenders counsel will be Nancy Hancock from Wigan.
No, that's well, we can discuss that, but
yeah, let's talk that out. Let's take that offline. But
we're seeing in this transaction there's only senior lenders.
Our counsel won't be Norton Rose though. We'll talk about that offline.
Okay.
Okay, any more questions, concerns? We're moving towards 10 o'clock, and I think that's a hard stop for some people. So
this is John Harity, and this is just an observation, and forgive me, I just don't have a chance to talk to senior leadership of the company often, but under the Biden administration's policies for green technology, there is a great emphasis on companies that have union workforces, and you all have been actively opposed to unions in recent organizing drives, and I don't want to engage in discussion, but I would just suggest that you look at that given the administration's attitude towards that kind of activity. Thanks.
Thank you and appreciate the comment.
So we're at resolution 6. Do I hear a motion to approve resolution 6?
This is Dominic. So moved.
Thank you, Dominic. Do I hear a second?
And this is John Harity. Even withstanding my last comments, I'll second the motion.
Thank you, John. All in favor?
Aye.
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 Opposed? Abstaining?
I'm going to abstain again. It's Vicky.
That's Vicky. Okay, Vicky's abstaining.
It's Matt, I'm also abstaining again.
And Matt is abstaining as well.
Thank you.
Okay. All right. Okay. Well, thank you, Mike. Thank you, Tom. Appreciate your presence here today. And we'll see you in discussions with council.
Sounds good.
Thank you very much. And we appreciate the support of the Green Bank and the board. Thank you. Have a good day and weekend.
Thank you. You as well.
Okay. These should move along. Thank you very much to the board for that. These should move along pretty quickly. Next up, if we just go to the next page. This is an extension request for the C4C Capital for Change Amalgamated Bank Green Bank facility that was approved by the bank's board of directors in October and was extended to March 31 at the December meeting. It's currently in documentation, but we might miss the March 31 extension complete by date. So we're just bringing forward a request to go to April 30th, which should be on the next slide. Yes, it is. There we go. So I'll turn it back to you, Madam Chair. This is a simple extension.
Okay. Again, any questions, concerns?
Madam Chairman, this is Bettina Brown Eyes. I just have a general question for the Green Bank. How concerned are you, and is there any exposure given the recent bank failures of Silicon Valley and Signature with any of our, Amalgamated, Liberty, East West Bank? Has there been any exploration of exposure?
That's we've looked at our main bank. Actually, Bettina is Webster Bank, and we've done a thorough examination of their position, and they've I don't know if you want to get into it, but we've looked at their everything from their common equity tier ratio, which is 10.7%. By contrast, Bank of America is 11.2, and Key Bank, where we have some other funds, is a little bit less at 9.1. It kind of compares, where other banks are pretty reasonably. The threshold for that ratio is 6.5. Moody's has something called a baseline credit assessment. Webster Bank and Key Bank, which is where most of our funds are, as well as State Street Bank, but Webster and Key are rated A3 in that baseline credit assessment. Just by comparison, Bank of America is A3 as well. JP Morgan Chase is A2, and State Street, where we have other funds, is rated A1. Webster, unlike Silicon Valley Bank, which I think 90% of its, or 94% of its deposits were uninsured, 50% of its deposits are FDIC insured. They have $54 billion in deposits. They actually grew deposits year on year by 2.5%, where most banks actually lost deposits. And they have a very diversified deposit base, from everything from health savings accounts to retail consumer deposits, which are at about 44%, and commercial deposits at 36%. And they also did a deal where they acquired an entity called Interlink, which is a cash sweep program administrator for broker dealers, which can supply a further $6 to $7 billion in deposits. They have 13. This is Webster. They have $13 billion in borrowing capacity from the Federal Home Loan Bank Board, as well, and the FRB, the Federal Reserve Board. That covers 60% of any uninsured deposits that they have. They have a low net charge-off ratio, good allowance for loan losses, strong capital base. Their operating efficiency is 40%, which is enviable. Most banks are in the 50-60% range. A higher is not good, lower is better. And the Fed just established the Bank Term Funding Program, which allows banks to take their available for sale securities and exchange them for funding at par without a haircut or discount. And the funding for that is fixed rate for a year. So we consider, Webster, as well as the regulatory authorities, consider it well capitalized. Same thing for Key, and certainly for State Street Bank. So in reviewing all of this, we're comfortable with our deposit spread and where we are today. But we're happy to take that offline if you want to explore that in more detail. But that's where we are.
Well, you certainly have done a lot of research to be able to convey all those facts and figures at your fingertips. Thank you.
You bet.
This is Lonnie, just saying quickly also, I mean, it amazed me a few years ago when we were installing the wind turbines in Litchfield Hills, and how there's an enormous amount of pushback, and Webster totally hung with us, hung in there, kept the deal going. And so they had a real commitment to doing green energy projects. So I was impressed by that. So that takes us to anybody.
So we have
Any
this,
more?
yeah, resolution for extension. Yeah.
Okay. Do I hear a motion to approve resolution 3 for the extension?
This is Binu, moving resolution 3.
Thank you, Benu. Do I hear a second?
This is Bettina. I second.
Thank you, Bettina. Okay, all in favor?
Aye.
Aye.
Opposed? Abstaining? Okay. Moving on.
Okay, this is another extension. It's related to our facility with Capital for Change, another Capital for Change transaction. This is where we are supporting their low-income multifamily energy loan program, which we have done for several years since 2015. And the bullet points on the screen just show you the progression of how we've expanded our support for that over time. We're not providing any additional capital support. We've got about $3 million outstanding, which will be $3.5 million outstanding, which will be shown in a couple of slides. But what they're asking for here is if we don't address this today, the availability period will end, and they have a pipeline of transactions that they want to bring forward. And they asked us if we would extend the availability period for an additional year. And so that's the nature of their request. These are the transactions that are currently being financed by our facility, and that's the balance outstanding that is directly supported by Green Bank Capital. And there's also participation. If we go back one slide, you'll see in the upper left-hand corner, Inclusive Prosperity is providing just about 1.1 million into this facility. They have not inked their participation agreement yet, but I was present at the investment committee meeting yesterday or day before yesterday when that was approved. So we're ready to go in terms of an extension and inking the participation so that Capital for Change can have full use of this facility and able to draw for the additional year going to March of 2024. So if you flip down to the couple of slides to the resolution, that's the nature of the request.
Okay, again, any questions or observations, concerns?
Is there any downside side to this?
No, John. No, all the trend. We haven't experienced any losses. In fact, there have been repayments of about 3 or 4 transactions over the history of Line. So everything is current in the portfolio at the present time.
Any more questions? Do I hear a motion to approve extensions?
So moved, John Harity.
Do I hear a second?
Second, Binu.
Thank you, Benu. All in favor?
Aye.
Aye.
Opposed? Abstaining? Okay. Moving on.
Okay. And this is should be straightforward. If we go to the next slide, this is for Posigen, the transaction where the board approved an increase for the Green Bank under the facility which expands. It's called an accordion, just like the musical instrument. It's expanding as shown in the lower right-hand corner there. So that second lien amount with Green Bank exposure, that's smaller than the second lien amount, which is where we are the lead lender, and we participate out with other banks and participants as well. So our exposure is capped there at 9.3 million. So that was approved by the bank. What we're coming by the bank's board of directors. What we're coming to you today for is just approval to exchange Forbright Bank, as shown by the exit sign up there, and bringing in Brookfield as the first lien lender. Brookfield is able to provide the total commitment here in combination perhaps with some other participating financial institutions, but they're able to offer a fixed rate which is below what is being paid by Posigen right now to Forbright, and with not knowing where interest rates may go. Currently, it's looking like interest rates could move lower, but the market is volatile. So a fixed rate is preferable for Posigen, so they're bringing in Brookfield to do that. So we need approval from the board to do that, which is shown on the next page. And these resolutions were vetted by outside counsel Wigan and Dana to make sure that we would be fully in conformity with what needs to be done under the revised agreements. Again, our exposure is not changing, and no material change in terms and conditions are being considered here. So we should just think about this as changing the senior lender in the facility, and that's it. Back to you, Madam Chair.
Again, again, any questions, observations, concerns? Do I hear a motion to approve Resolution 7?
This is
So
Bettina.
moved, John Hardy.
And Ms.
I'll
Bettina
second.
second.
Okay.
Either way.
So John moves, Bettina seconds.
Sure.
Thank you. Any opposition, opponents? Any abstentions? Okay.
So, okay. For the record, everyone else was an aye.
Good.
Yes,
That's what I thought.
and I have to leave. I'm very sorry.
Okay, but thanks for hanging in with us.
Yeah, great to see you all again and be back on this board. Take care.
Great. Thanks.
Bye.
Thanks so much.
Thanks. And thank you to the board. That does it for me.
Thank you. So I believe, in fact, I'm very eager to see this, the Pura presentation. And we're sort of going to give us Pura has been so, I have to say, when I chair of the Energy and Technology, I never saw as active and engaged a Pura entity as we're seeing now. And Marissa Gillette and her team are here to talk about the 2022 Clean and Renewable Report. And I know that Brian Garcia is eager to introduce them. Brian.
Excellent. Thank you for that setup, Chair Reed. So I want to introduce Managing Director Josh Ryer and Rate Specialist Will Taylor, who are going to walk us through the 2022 Clean and Renewable Report. I think you all will find it very informative. Look back at the last decade of policy and how well we're doing on those policies. So they're going to present for about 30 minutes. And then, so hold your questions to the end, and then we'll turn it to you for questions. Why don't I turn it to Josh? Right.
Great. Well, thank you so much, President Garcia, and thank you so much, Chair Reed, particularly for those kind comments. So as they both mentioned, we're here to talk about a new annual report that we've put out the last 2 years now. And to give you some insights, well, an overview of the programs that we oversee and the procurements that we ultimately also approve, and actually the deployment data that we've seen and that the state's seen to give you a sense of where we are in meeting our goals overall. So we can go to the next slide. So I'll quickly give an overview of the docket process, how we got here, why we're doing these annual reports. I'll talk very quickly about the purpose of the report, and then we'll get into takeaways for each program that PURA oversees and are implemented by the utilities, and we'll quickly touch on deep procurements, which, as I mentioned, we do also go through us. And then I'll end with some interesting in-state generation data that we think is important to flag in the context of all of this, which certainly all these programs have multiple objectives, one of which is, of course, meeting our in-state climate goals. Next slide, please. Great. So I'm sure folks have heard me or the chairman or others talk about PURA's Equitable Modern Grid initiative previously. There was 11 proceedings as a part of that. I just want to note that this report actually came out of one of those 11. We started back in October of 2019, and we identified the fact that the state has lots of great clean energy programs that have been supported by many others, the Green Bank, the General Assembly, of course. But we didn't have actually one place where all that data came together. There wasn't one place to analyze, what's our progress on those programs to date, and what have we learned, to then put that back into our public policy process, right? So we can make more informed decisions, both as an agency that oversees these programs, but also to help inform other policymakers in their decisions regarding these programs and other clean energy initiatives. So we initiated a docket back in 2020. It culminated last year in the first ever version of this report. And then on February 22nd of this year, we issued the second report. And there's various dockets this was done through. For those of you that have not had the distinct pleasure of going through our docket system yet, there's a slide at the very end that gives you a guide on how to do that. Next slide, please. Great. So the purpose of this report, I just went over, but to briefly reiterate, is to give details on the status of the clean and renewable energy programs in the state, and to provide insights into stakeholders that might not have been, one, readily apparent previously with data in disparate places, but also to provide our own analysis and insights on our progress on these programs. Next slide. And so we're not going to cover everything that's in the report. I certainly, for folks that really want to dig in on deployment data by sector, by program, there's tables, there's charts, there's all sorts of great stuff in the report. Here you have a visual representation of all of the different things that are included. Things like virtual net metering and the state's RPS are things that we're not going to really dive into in depth in this presentation, but at least wanted to acknowledge the fact that they are included in the reports. Next slide. Great. So Will and I are going to go through a couple of programs that we think are important to note, and then most importantly, the key data that we're seeing regarding those programs. Next slide. So first off, so this is a graph that shows our deployments by program, essentially. So what our efforts in this state have directly led to in terms of clean energy deployment since 2011. So you can see a significant increase. I think our takeaway from this is that we've made continued steady progress through the mid 2010s, and we're continuing that with that progress. I think for folks that will remember, and I know certainly Chair Reed, you'll remember Public Act 1850. There was lots of concern that this trend wouldn't continue around then, and we're very proud to say that it has indeed continued, and in places we've actually increased, and you'll see in 2021 and 2022, those were actually the most successful years to date for Connecticut in residential solar history, and we'll talk about that a little bit more in a second. Certainly, though, we want to acknowledge areas that we can improve. There's always going to be those, and one is achieving our state goal, our programmatic goal, which we adopted from the Biden administration, the Justice 40 initiative, to make sure that all of our programs are benefiting 40% in underserved communities, specifically LMI customers in EJ communities. We're lagging behind that 40% target, but certainly we plan to redouble our efforts with the help of the Green Bank and others and through our docket process to make sure we get there. We haven't, the shared clean energy facility story is a complicated one to tell. The deployment numbers are not there yet, but we think there's reason to be optimistic, and I'll get into that in a little bit. And then one thing that we think that this report helps with, and certainly one of the few grid mod efforts dockets that we haven't finished yet, our RU10 docket looking into this last point, which is really understanding precisely how all of these programs fit into our climate policies, and from Pierre's perspective, the state RPS. What do we do? Are we being as thoughtful as we can about the recs that are associated with all these programs that we do actually have ownership over? So for the next slide, I'll turn it to Will to talk through the residential and non-residential programs.
Good morning, and thank you again for having us today. I'm going to start, as Josh said, going through several of our newer clean energy programs, starting with the RRES program, or Residential Renewable Energy Solutions. And this program replaces our legacy net metering and residential solar investment programs. It began recently in January 1, 2022, and is slated to run for 6 years and is administered by the electric distribution companies, both Eversource and UI. Eligible projects include wind, solar, and fuel cell projects up to 25 kilowatts. And each of those projects is granted a 20-year term under either a netting or buy-all tariff. And this entire program was, or not this entire program, but multifamily affordable housing was made eligible for this program as well under Public Act 2148, which we believe is a helpful addition to this program because it allows multifamily homes to participate without having to compete against commercial and industrial projects as they otherwise might have needed to be. Programmatically, when we made individually metered multifamily homes eligible for this program, starting January 1st of this year, it is necessitated that at least 20% of the financial benefit of the solar is distributed equally amongst tenants of those facilities. And as with most of our clean energy programs, we have a target of 40% deployment in low income and economically distressed municipalities. And we strive to achieve this through incentive adders and other measures to reach this goal. Next slide, please. So our objectives that are set for the RRES program include maintaining historical deployment levels while working to achieve that 100% zero carbon electric grid by 2040, which coincides with state goals. The program aims to achieve these goals while balancing both participant and non-participant costs and benefits, while ensuring program accessibility and encouraging inclusivity. And that includes deployment in low and moderate income and environmental justice locations. We can move on to the next slide, please. Thank you. So this plot on the left here shows the spatial deployment of residential solar in Connecticut to date. And we can see that darker municipalities coincide with more deployment. And the black dots are distressed municipalities, and the orange horizontal stripes are the environmental justice communities. And you can get a grasp from this visualization that we are doing a relatively good job of getting, via our adders and other incentives, deployment in those low and moderate income areas in this program, although we're still not quite at that 40% target, but we are always evaluating ways to improve the program and reach that target in our annual review process, where we welcome stakeholder input to all of our clean energy programs. And as Josh alluded to earlier, in the table on the top right, you can see the residential solar deployment for the last several years in Connecticut. And of note are 2021 and 2022, where we have about 85 megawatts of deployment annually. The 84.43 is only through November in 2022. So that number is probably a little bit higher in reality. Next slide, please. And so now we'll take a look at sort of our solar deployment a little bit more regionally. So this plot in the top left is colored by deployment per capita by state. You can see that most of this states in the darkest or highest tier are in the Southwest United States. The few exceptions in the Northeast are Vermont, Massachusetts, and Rhode Island. And accordingly, those three states have ranked first, second, and third, respectively, in terms of deployment per capita to date. However, two of those three states, Massachusetts and Vermont, are projected to have significantly slower growth and are actually ranked 7th and 8th in projected deployment per capita over the next 5 years in the Northeast. On the contrary, Connecticut has been remarkably consistent relative to most of its peers in the Northeast. It's shaded in the second tier in that plot in the top left. And to date, of the 9 states in the Northeast, it has the 6th highest deployment per capita and is projected to have the 6th highest deployment per capita over the next 5 years. One important caveat to that, I think, is that this data is taken from SEIA, and it may not perfectly encapsulate the recently expanded statutory caps for solar in Connecticut amongst several of our programs. So that projected growth may actually end up being a little bit higher than anticipated. Next slide, please. The next program I'm going to talk about is the Non-Residential Renewable Energy Solutions Program, or NRES program. And this is the successor program to the LREC-ZREC program and legacy virtual net metering, and supports commercial and industrial projects. It also began in early 2022, much like the RRES program, and also similarly is slated to run for 6 years. Again, this program is administered by the EDCs, Eversource and UI. And in 2022, we had only one solicitation, but starting in 2023 and moving forward, we'll be holding 2 solicitations annually. Projects eligible for this program are up to 5 megawatts AC, which was recently expanded from 2 megawatts. And the statutory cap was also recently increased to 110 megawatts from 60, I believe, 50 and 10 for low emissions. And similar to the RRES project, any projects that participate in the NRES program are eligible for a 20-year term under a netting or buy-all tariff. And inside this program, there are 4 categories: low emissions, small, medium, and large. And 3 of those 4 are subject to competition. The one which isn't is the small project size, which is a first come, first serve opportunity. Also recently allowed per statute is oversizing on rooftops for projects that are eligible for this program, to take advantage of that rooftop space and not waste it. And otherwise, aside from oversizing on rooftops, any projects such as ground mounted systems are limited to being sized to load. Looking at the non-residential renewable energy solutions program objectives, the goals here are sort of to just foster that sustained, orderly development of the renewable energy industry, as we saw earlier on our major takeaway slide. We have been to date, to sort of continue that growth in the future, and deploy our full megawatt capacity allowable under the statute to the extent possible, while making sure we're achieving least cost outcomes for ratepayers through the annual solicitation process. And of course, we want to enable accessibility for all customers, and also in this program, encourage that deployment in environmental justice communities. So looking at some of the non-residential solar deployment to date, since the NRES program just started in 2022, and a lot of these projects tend to be a little bit larger than residential programs, we don't have much deployment to date, but we do have data from our predecessor programs, LREC, ZREC, and VMM, which you can see on the left-hand slide. You may notice there's a slight tick down in the rate of growth in 2022, but that's likely due to the pandemic and also due to the fact that when this data was collected, it wasn't through quite the end of 2022. I believe it was October or November-ish data. So that's sort of those two factors sort of account for that slight tick down in 2022, as well as a new program, the NRES program, coming online in 2022. So looking at the bottom right here, we see some data on the NRES program itself, and we see how we've done it. The program was able to achieve close to the statutory target in approved projects this year. Almost 54 megawatts of the 60 available were selected. And if you notice, most of the megawatts which weren't selected come from the low emissions and large zero emissions categories in UI. And we believe that allowing statewide solicitations may help resolve this problem while ensuring lower cost outcomes for ratepayers. One good example would be to look at the low emissions category, which only dedicates 2 megawatts to UI. So currently they can't select a project which achieves, the full program capacity of 5 megawatts. Whereas if we had a statewide solicitation, a project in UI territory that were, 3, 4, 5 megawatts would be eligible for participation and may be selected as, a low cost outcome for ratepayers as well. I'm going to turn it back over to Josh now to go over the SCEF program.
Perfect. Thank you so much, Will. So the Shared Clean Energy Facility program is really for front-of-the-meter systems and allowing, so deploying those systems, but then providing the benefits of those projects to low-income customers and others that aren't able to take advantage of the first two programs that we just went through. And of particular note as well, for folks that aren't familiar, this is the third. The two programs that Will just went through, as well as the SCEF program, are the three programs that were authorized in Public Act 1850 and then amended in 1935. This program, SCEF, like I said, is really focused on deploying front-of-the-meter systems, and it has the three goals that we have listed here. First and foremost, to annually and cost-effectively deploy up to the megawatt cap, which was 25 megawatts, and that was recently increased to 50 megawatts, to lower or eliminate barriers for entry for developers, and of course, as I already mentioned earlier, to provide savings to specific categories of customers, particularly LMI customers. Next slide. So I mentioned that there is a bit of a complicated history to explain with the deployment here. So far, so prior to the SCEF program that I just mentioned, there was actually a SCEF pilot program that was run by DEEP, and they selected 3 projects, one of which has come online. And then in 2020, the first year of the 6-year program, the SCEF program, got off the ground. Now, as you all will recall, 2020 is when the pandemic hit. So the first solicitation was run and bids were submitted slightly before the effects of the pandemic were felt. And so we haven't seen, usually it takes both with the NRES program and its predecessors, LREC, ZREC, and SCEF projects about 2 to 3 years for them to come online. So this would be year 3 from the auction that occurred in 2020. And so as of the end of last year, we hadn't seen any projects online, but certainly as I just mentioned, there's the first auction occurred essentially when the pandemic hit, and then after that, there's supply chain constraints. So pricing for these projects has been difficult, right? And certainly has changed over the last couple of years. So we've seen projects become not economically viable. What I will say is that we see great promise in this program. As you can see, this most recent year in in the solicitation, we saw up to essentially 70 megawatts of projects were selected. So we'll certainly see over the next couple of years, within 2 to 3 years, if we actually are able to deliver on the promise of these 70 megawatts. But we're hopeful now that we're, knock on wood, through most of the effects of the pandemic and the supply chain constraints, that these projects are more likely to be successful. The last thing I'll say that's not on this slide, but just to echo what Will said, I think the SCEF program would also benefit from a statewide solicitation. One thing that's important to note is that the UI service territory, we typically split these programs 80-20 between Eversource and UI because that's their relative loads. So Eversource has roughly 80% of the customers, or 4 times the number of customers as UI does, or at least in terms of load. But what that doesn't take into account is the fact that UI's territory is much more urbanized, right? There's less space for these types of projects. And so we're seeing that if we were able to have a statewide procurement, that actually might allow us to look at more projects would be eligible. And again, as Will mentioned, we'd likely have more economic outcomes. That I'm going to turn it back to Will to talk about the Energy Storage Solutions Program, which I know all of you are very familiar with.
Yeah, I'll try not to take too long on this program, as I'm sure most people on the call are very familiar with the ESS program, which began this year in 2022 and is slated to run for 9 years, administered by the EDCs as well as the Green Bank. And again, similar to NRES, we had 1 solicitation in 2022, and moving forward in subsequent years, we're going to have 2 solicitations annually. Some key details are that this program was administered by Public Act 2153 with the goal of deploying 580 megawatts. And there are 2 incentives in this program, both active dispatch, which is a performance-based incentive, and a passive dispatch, which is an upfront incentive. And projects can participate in this program by choosing to participate in both parts of both active and passive dispatch. And we also now allow just active dispatch only projects. Additional details are a residential cap of $7,500 and a C&I cap of 50% of project costs, which also has project sizing caps of 2 megawatts or 150% of the load. And we have a link to the program data platform here as well. Next slide, please. This program has 7 objectives, so I won't run through all of them, but they do include ensuring cost effectiveness for all ratepayers while sustaining and fostering the storage development industry in the state of Connecticut, while still providing a focus on vulnerable communities and improving customer resilience to grid outages as well, we see as a focus for this program. And so this slide shows the very early residential battery storage deployment to date. And as you can see, we've struggled a little bit here, more so than compared to the RRES program early on, which is maybe to be expected, and the distressed municipalities, which is something we're trying to work on. And just in general, residential deployment is a little bit low right now. When data was pulled for this report, it was about 0.95 megawatts that had been approved for residential, which is just under 2% of the 2024 goal, whereas C&I has been extremely popular. And at the time of this report, already had 125.47% of the 2024 goal submitted or approved. However, while residential is a little bit behind C&I, we do expect to see a lot of growth in the coming years. And that's just part due to program awareness. As the program, people, as citizens and residents in Connecticut become more aware of the program, we expect, that growth, as well as the recent incorporation of active dispatch only projects. And I do think we're maybe starting to see that already. As of this morning on the Green Bank's portal, there's about 1.3 megawatts of residential applications up from 0.95 when data was pulled from this report. So that's a pretty significant percentage improvement. Yeah. And I will turn it back over to Josh to go through the electric vehicle charging program.
Great, thanks so much, Will, and I'll take us home. So this program, the electric vehicle charging program, as well as the energy storage solutions program, both came out of PURA's Equitable Monitoring Grid, our third and fourth reopener. Certainly, we couldn't have done the energy storage solutions program without the public act that was passed. But this program is currently in place, and it started last year, and it has these 4 objectives that I've listed here. And really, it's I'll highlight the one on the top left corner, which is to help the state meet its ZEV MOU goal of deploying about 150,000 EVs by 2025. And that actually increases, I believe, to about 500,000 by the end of 2030 to meet our Global Warming Solutions Act goals. And that's based on some GC3 analysis that was done, I believe it was 2019. And then the bottom right, to make sure that we achieve an equitable transition to wide-scale EV deployment. Of course, that's a theme you've seen throughout our work, and I know yours as well. Making sure we're thoughtful and ensuring that the rollout is equitable is paramount. Next slide. Great, so there's 2 tables here. The one on the top right you'll see is really the goals that we set. So how we, and specifically the deployment goals that we set out. So as you can imagine, as a utility regulator, where all of these programs are financed by ratepayers, right? So we're always hesitant about and mindful of how much money we're allowing, how much of ratepayer money we're allowing to be used. Of course, with EVs, it's a little bit of a build it and they will come scenario, right? If you don't have the infrastructure, you can't, folks aren't going to get EVs. And with EVs, we actually have increased electricity sales for the first time in 20, 30 years that will actually help to lower everyone's rates, right? So from a utility regulator's perspective, wide-scale deployment of EVs would be massively beneficial to the customers that are served by the regulated utilities. But having said all of that, we of course recognize that we want the market, the EV charging market, to get to a place where it doesn't need, much like the solar industry and your all's administration of the RCIP program, we want the industry to be able to get to a place where it does not need ratepayer funds. Right. So the targets that you see in the table on the top right actually represent only 50% of what has been modeled as being needed to actually meet the EV deployment goals that I mentioned on the prior page. And again, that's because we think that we should subsidize a portion of the rollout, and then hopefully the private market takes it from there. We're really happy to report, and you'll see on the bottom right here, I know there's lots of numbers and data, but what I'll highlight for you is that the DCFC, so the fast chargers that you see along, I-95, 84, those, we actually exceeded our goal already for year 1 for those chargers. So the total number that we're providing incentives in 2022 were 136. And that's, and the goal for the 3-year cycle was 137. So we're well on our way to meeting the total goal of 550. The other area that we exceeded expectations and met our 100% of our 3-year goal was also in multi-unit dwellings as well, where you can see it's over 1,000 projects were actually approved in the state last year. Next slide, please. So one area that we're tracking with great interest is that you might have seen on the last slide that in the first 3 years of this program, we're hoping to help incentivize the deployment of 15,000 residential chargers. In year 1 of the program, we approved about 1,500, so about 10% of that goal. So obviously the pace of deployment is going to have to increase. We're hopeful based on some of you might have seen some of the ads that Eversource has put out to help with this. So again, we're hopeful that we'll get there, but so far we've had 1,500 applications. And what's really important about this, certainly there's a number of customers that will install residential chargers that might not go through our program, but why we're hoping that they will, and why we're providing an incentive for them, is that if they go through this program, it gives us the opportunity to, much like the Energy Storage Solutions program, provide an opportunity to manage that charging, to make sure that that charging is happening at times that are most optimal for the grid, and actually at this point are not happening at times that would be costly, most costly for the grid. Right, next slide. And then real quick before I get into very quickly the in-state generation data, just wanted to point out the data on the deep procurements. It's led to 1.6 gigawatts of deployment of clean energy. Also really important to note, and for folks that haven't looked at the integrated resource plan, certainly encourage you to look at that. It highlights the fact that DEEP actually has the procurement authority to procure up to the equivalent of 95% of our load. So certainly a large number. And then I'm sure folks saw, but DEEP's also put out recently announced a plan to run a new solicitation for clean energy. And they had, I think this number has increased recently, but in 2022, they highlighted that about 170 megawatts of projects they had previously selected didn't end up getting deployed. So they're interested in selecting projects to replace that. Next, you can actually skip 2 slides ahead. So just very quickly before we get to questions, we wanted to highlight some trends in in-state generation, because again, as we're thinking through this data and trying to provide the best insights we can on the data, it's important to contextualize what we've presented in terms of deployment and what that means in terms of emissions reductions. So as you can see here, the in-state generation we've increased the amount of clean energy generation that this state produces. So that's the graph on the left. And then the graph on the right, you can account for GHG emissions in different ways, but you can see a steady decline in the consumption-based accounting of GHG emissions, with a slight uptick in the generation-based approach, which just means that that fossil-based generation has come online in the state of Connecticut recently. Next slide. The slide on the left just shows generation by fuel type. So mostly natural gas generation in the state of Connecticut, with, of course, Millstone in southeast Connecticut providing a large amount of production, usually between 16 and 17 million megawatt hours per year. And then what's really interesting on the right here is that actually Connecticut is a net exporter. So we produce more energy than we need for our state. So that's going to become a really interesting and important point in when we consider how we get to 100% zero carbon moving forward. Next slide. And then the last slide is just to show how much, yes, we're a net exporter, but how much we generate compared to our New England neighbors. We generate a significantly more than the rest of our neighbors, and the split is about 50-50 in terms of clean energy generation to fossil base. So with that, if we can go to the very last slide. So actually, I'm going to start with the bottom and what we're thinking about for future reports. Things that others have pointed out to us and that we're working towards adding to this report in the future is an in-depth cost-benefit analysis of each program that we've gone over. Certainly, folks that are familiar with the analysis that Guidehouse and the Green Bank puts forward with Energy Storage Solutions program is really kind of best in the nation. So we're hoping to be able to replicate that for our other programs, to be able to provide folks a better understanding of what are the societal benefits of these programs, as well as what are the ratepayer costs or benefits. We also want to dive more deeply into the emissions reduction data to give a sense of, okay, which programs are we essentially getting the best bang for our buck in terms of meeting our emissions goals, and then pairing that with the cost benefit data. And then, of course, I think the Green Bank's data portal on the Energy Storage Solutions Program is kind of the gold standard in terms of what we'd like to be able to see, how we'd like to see all of this data being able to be presented moving forward. So certainly we're working towards that. And then as you can see, the bullets at the top there just list, there's, as I mentioned earlier, there's lots of other good stuff, not only in this report, but in the docket that's associated with it. So folks that are interested, these are the types of other things that are in that report. So with that, I'm happy to turn it back to Chair Reed, President Garcia, for any questions.
Excellent, Josh. Thank you for that. That was incredible, and we only got a piece of the picture. I would say there are other pieces, as Josh alluded to at the outset, that are within this report. For those of you who are like into how policy results in enabling markets and markets resulting in impact, there is an incredible amount of data in that report. So for you data wonks, jump in. It's a great report. But questions for Josh or Will? I might get us kicked off here, but think about your questions.
I have a question.
Oh, please, Adrian. Thank you.
Yeah, thank you so much for this report. I'm anxious to have time to delve into it even more. I did want to ask you about projections. I've been doing some research on workforce development, particularly in energy conservation jobs. And while I see in different reports how many people are actually employed in clean energy and in energy conservation, I don't see projections. Do you have any idea of where we're going and what are our objectives? Do we have objectives in terms of, looking at it in a 2-year or 5-year term?
Yeah, that's a fantastic question that I don't have a good answer for. I'm going to be honest. So energy efficiency and conservation. I just want to point out, and to be clear, the conservation and load management plan is overseen by the Energy Efficiency Board and DEEP. So we don't have as much data on that or insight into that. I will say to be completely fair, we don't really have any data or insights on the programs that we do oversee on that. I think that's a fantastic question, and I think it was the Green Bank that put out that report. Was it just over a year ago now on clean energy jobs in the state? I unfortunately don't have a good sense of what the future holds or data on that. The last thing I will say, and not answering your question, is that we are really mindful. One thing we've heard from developers is long-term certainty, right? Having very clear policies that aren't going to change drastically, and a long-term commitment to those programs. And so that's why both the Energy Storage Solutions Program and the EV Charging Program, we made them 9 years. We have annual check-ins and 3-year cycles to critically evaluate the programs. But that, from a job perspective, was really important for us because we wanted to send the signal to the industry: come here, spend your money here, and stay here because we're committed long-term to you.
Yeah, that's great. I would encourage us all to look at what the projections are, if only because on every level, whether it's federal, state, or local, everyone is talking about climate change and all of the measures we have to invest in order to make sure that we can stop it. So if we're going to be successful, we have to know who is going to do the work and what qualifications they need to do that work. So job descriptions, looking at manufacturing, looking at the service industry, looking at contracting, I think it's going to be critical to make sure that we have the man and woman power going forward that is really qualified to do these jobs. I do have a second question, if you don't mind me preoccupying everybody for a little bit more. You talked about SCEF, and I'm very interested, Brian knows this because I've picked his brains on it already. I'm very interested in seeing how the community can own the means of production. And so this is an opportunity because we have the technological means to do this, but now do we have the policy and the financial means to have the community invest in its own production of energy?
Yeah, that's a fantastic question. It would be very difficult to change based how the current program to be able to do it that way. I think there's lots of different models that we could look to adapt either this program or to change the program. Frankly, the approach that we took here is the developers are good at developing projects and submitting them in, and so we can we select lowest cost bids, and then we have good data, and they have understanding of what communities they're in, and so making sure that those communities get the benefits. So we focused the program, and that was kind of the framework, that the statutory framework. But having said that, there's no reason we couldn't in the future look to a model like you're mentioning. I think more and more we're trying to get add in location specific requirements. Like for example, with certain projects, all of the benefits will go to, or not all, but the majority of the benefits will go to the folks in the community that are near the project. We're looking towards community benefit agreements. So I think that would be consistent. What you're proposing is consistent with that trend, but isn't unfortunately something that we could effectuate under the current paradigm.
Well, we should think about it.
Yeah. No, I appreciate that thought and suggestion. We'll definitely take it back.
Thank you.
Thank you, Adrian. Others?
This is John Harity. I had a question. Are we, what are we doing to take advantage of the federal money that's now available under Biden's climate change programs?
Yeah, it's a good question, and actually I might bring Brian in to supplement this at all. So to the extent we can, I mean, you're probably familiar with PURA's process, and if we do program changes, we have to do that through an adjudicated process, and we as we're quasi-judicial, we're essentially judges, so we can't talk to participants during that. So we do have some restrictions on communication. Having given that caveat, I mean, it's obviously in the best interest of everybody in the state for the state agencies to be coordinating to make sure we get as much of the federal money as possible and are effectively distributing that. So the Green Bank, PURA, and DEEP are all coordinating on making sure that we're putting our best foot forward and asking for the money in certain instances, and certainly PURA. To the extent we see that the utilities are eligible for programs or for funding, we are encouraging them to do so publicly and in our dockets. In terms of, so that's the, how are we coordinating to make sure that, we're in the mix to get the funds. If I'm interpret your question correctly, I think it's also, how are we positioned to when it comes in, making sure that it's being effectively distributed and utilized. And the answer to that question is really, we have these annual processes to make sure that these programs are achieving their objectives as best as possible. And that includes making sure that we're incorporating federal funding, aligning incentives, and in some instances, it actually includes advocating at the legislature. One thing that I believe it was Representative Steinberg's bill brought up is making sure that we have alignment between the SCEF facility eligibility requirements and the federal incentive guidelines. And that's something we actually think that we can do ourselves in the programs, but it's just an example of where we're trying to proactively make sure that everyone can apply, and then we have a process through our dockets to make sure that money is utilized. Anything to add to that, Brian?
Oh, that was great, Josh. Just in addition, John, what we will provide is Representative Ali Brennan chaired a sustainable and renewable energy caucus where he asked this very question. So I'll share our Green Bank presentation to their caucus 2 weeks ago, just so you can get a sense of that. And then, you know, the board has been very supportive of the staff's Dream Big strategy. You approved back in January an increase in staff hiring to get ready for the various tax credits and adders underneath the Inflation Reduction Act. So our teams are gearing up for going out to the market more in targeted communities with all those additional incentives coming from it, as well as competing for the greenhouse gas reduction fund. So we're very focused in on IRA. I would say from an Infrastructure Investment and Jobs Act perspective, there are some emerging competitive opportunities that we submit public comments into, concept papers into, and in some cases we're encouraged, in some cases we're discouraged to provide proposals. But we've got all of ours lined up to our comprehensive plan in terms of what we're looking to go after. But yeah, it's definitely an interagency data sharing activity.
Yeah, and just one last thing that I was realizing as you're speaking, Brian, all three agencies, PURA, DEEP, and the Green Bank, have websites that we've posted all of our submissions into IAJA or comments. So if you're interested in learning more on what we have done so far, I'd encourage you to go to those websites.
And folks, this is Vicki Hackett. Deep would be happy to come and present to the board about how we're rolling forward with all of the various sources of federal funding.
Great, thank you, Vicki. Any one final question? Time.
This is Dominic. Just one quick question. Just on the battery storage deployment and the residential, the slow uptick there. I think you mentioned there was maybe a change to the program that you feel like might cause more uptake there. And then has there been any, I know it's early on, but has there been any consideration if that continues to be slow of sort of reallocating the program goals to, if there's a lot of demand for C&I and not as much demand for residential, that those tranches get realigned?
Yeah, that's a great question. Will, would you mind taking the first one first, and I'll take the second one?
Yeah, sure. So as far as the slow uptick in the program change, initially in this program, participants were required to participate in both active dispatch and passive dispatch requirements, which are, you know, a set of requirements to have your battery available to dispatch for grid management purposes at different times and different set number of events throughout the year. Throughout our stakeholder process, we sort of learned that certain residents were inclined to participate in other programs or just dissuaded based on those requirements, and were seeking to just join ESS as active dispatch only participants. And so that's a change we made to the program this year. So starting January 1st of 2023, projects can enroll as active dispatch only and don't have to participate in passive dispatch if they elect not to. So we expect that to help. So this sort of simplifies, I guess, in a way, program requirements, or just reduces the necessary availability of batteries for managed charging.
Great. And then to add on that real quick as well, so Public Act 2153 directed us to develop the Energy Storage Solutions Program. And so, and why I note that is that that's, you know, one of the reasons that we did it. But also there was a pre-existing storage program in Eversource's territory before we established this program. So we're seeing some hesitance between some developers to move over from the legacy Eversource program to our new program. And certainly we have thoughts on that we've included in our decision, a recent decision, the Energy Storage Solutions Program. But we do think that having one program moving forward is just most cost effective for ratepayers and would help actually accurately reflect what residential storage deployment is in the state. The other thing I would to your second question rather, is we did look at and thought about reallocating the megawatts. Honestly, at this time, it's more well defined what the cost benefit is for residential than it is for CNI, as there's so many different applications and load profiles, et cetera. And this is, I should be very clear, this is my personal opinion and doesn't necessarily reflect the opinion of the authority. But for me personally, it's still, we're still feeling out exactly what the cost benefit is for these different CNI projects. What we have said historically is that the 3-year cycle, there's a big, so we have these annual program reviews, but the third year is a big kind of refresh to make sure that everything is moving along smoothly. So if we were to reevaluate where the megawatts are being allocated, I think it's most likely to be at that third year check-in. But again, that's my personal opinion and not necessarily reflective of PIRA.
Great, thanks.
Josh, Will, thank you very much. That was a comprehensive overview of the report, and I would just recommend to the board, if you're into all the details and these sorts of things, the report is in the materials. Check it out. And again, Josh, Will, thank you very much for being with us here today.
Thank you for having us.
Thank you.
All right, back over to you, Chair Reed, for our final agenda items.
Thank you, Mr. President. I think we want to get a sort of sense of how the legislative session went, and I think that tees up James DeSantos, who is our Associate Director of Legislative and Regulatory Affairs, or as when I was on the committee, we used to call it the guy in the legislature. And so we're eager to hear. I understand James has had a really, really good session interacting with folks. And if along the way you might talk about SB 7 and wondering whether that has any chance of making it through. James DeSantis.
Thank you, Chair Reed, and good morning and nice to meet you all virtually. I'll try to run through this as quickly as possible. I know we're running up to the 11 o'clock timeline here. So the legislative session opened on January 4th and concludes on June 7th. So all legislation must pass both the House and the Senate by midnight on June 7th, or that piece of legislation will have to be resurrected in the 2024 session, which will begin in February. What's interesting about 2023 is it's an odd year, which means a long session. So this allows any legislator to introduce as many pieces of legislation as they want on any issue they could think of. So this resulted in nearly 1,000 bills being introduced this session. The Green Bank was initially tracking a little over 120 pieces of legislation. That will dwindle significantly once the committees start JFing, joint favorable, which is their favorable committee vote out of committee, so on a piece of legislation. So right now we are at the midpoint of the session now. A lot of proposed bills that have not been raised by committees have died, combined into other bills. It also marks the near conclusion of the public hearing process and the joint favorable committee deadlines. So the JF process is each committee has a deadline in March where they need to either favorably vote a committee bill out, or the bill no longer is alive for the time being. So that will dwindle probably our bill tracking down from 120, hopefully to about 30 to 40 pieces of legislation that will directly affect the Green Bank's mission, clean energy deployment in the state, or any potential impacts to quasi-public agencies. So for the sake of time, I'll just highlight the first two bills below, as the first is a Green Bank proposal and the second will directly impact the Green Bank if passed. The other two bills, one of the ones that Chair Reed referenced, Senate Bill 7, is the aircraft carrier or omnibus bill. People are calling it the fleet. As of now, it has 24 sections that we know about. It does include everything that you could possibly imagine that came out of the Energy Committee. It's combining 7 bills that we know about already. My guess is when it's all said and done, it'll have about 50 to 60 individual sections on 50 to 60 individual issues. So that's going to be a very large bill. 6851, this is the Green Bank proposed legislation that incorporates the legislative recommendations by the Hydrogen Task Force, which was led by Brian Garcia and Sarah Ari. This would be the first public policy of its kind in the country that ties clean hydrogen to community benefit agreements. That's why we are adamantly pushing this bill through as hard and quickly as we possibly can in order to reinforce our regional hydrogen hub application. This was voted out of committee this week on Tuesday, which was the last meeting of the Energy and Technology Committee. And like every other bill that came out of the Energy and Technology Committee that day, it was made very clear that everything is a work in progress. So on to the next bill, which is 961. This is actually a Council on Climate and Jobs bill that has the Green Bank housing and operating a program to perform solar and energy efficiency audits on all of Connecticut's schools, which we've estimated to be a little over 1,000 facilities at this point throughout the state. As it stands now, the bill would allocate $100 million in state bonding for staff at the Green Bank. $25 million of that 100 would go to staff and to finance the audits. 75 would be used to backstop the loans to distressed municipalities. This was voted favorably out of the Environment Committee, and we're just waiting for the final copy to come. To your point, Chair Reed, so 6764 is another bill. This isn't also going to be an omnibus bill. This is what Josh Ryer referred to with the income limits aligning the state with the federal. This is going to be put into this bill as well. This also initially had a NRES capacity increase, which will be removed from the bill, but it started the discussion on increasing that cap. It also has a very controversial uniform tax language in there. But on the positive side, it does create a carport working group. So I'm optimistic that that'll pass so we could see how that carport deployment is progressed in the state. Senate Bill 7 is what you're referring to, Chair Reed. It is going to be an absolutely enormous bill. They're claiming it as the Take Back the Grid Act. They're looking at this bill to be a bipartisan bill. So everything in there will not be controversial at this point. I think all the controversial pieces will be into 6764 at this point. So that's all I have for this time. I just want to say it's a very fluid process at this point. There's a lot of moving parts. I know that you may have a lot of questions, and if you do on legislation that's moving through the General Assembly, please just give me a call or send me an email. I know some board members have done that already, and I'll be happy to update you on any particular issue as we move through the process. So thank you.
Thanks, James.
Brian, I just have
that-
to make one point
ahead.
of clarification on that, on the report. The Senate Bill 961 was an initiative from the Connecticut Roundtable on Climate and Jobs, which
Sorry about that.
Yeah, I'm on the board of, so I want the billing. Thanks.
Yeah.
You got to fight for it, John. You got to fight for
Sorry for the typo, John.
it. Any other questions or clarifications? Okay. Oh, and then we're going to do a Green Liberty Note update. Is that Bert again?
That'll be David Beach. I think he's on.
Oh, David Beach. I'm sorry, of course.
Hi there. Thanks,
Hi, David.
Chairwoman Reed. I don't have a great background today, so I'm just going to be joining via audio, but really excited to give the board an update here on our Green Liberty Note program. So just to provide a little bit of context, I want to bring back up the board's initial approval of this. We went to the board originally in the summer of 2021, where the board approved up to $2 million of Green Liberty Note issuances. That would be in quarterly installments of $250,000 over a span of 2 years, backed by the SBA loan revenues and issued through a taxable security. Some of the strategic benefits that we mentioned at the time were to build upon our great success with the Green Liberty bonds, improve access to green investments, especially for those retail investors, enhance our brand by continuing to be innovative and one of the few people to offer short-term green certified bonds, and to establish another avenue for liquidity for the bank. So with that kind of framework and context, I'd love to jump into an update here on the program. So in that spanning time, we have issued 5 rounds of Green Liberty notes, one every quarter. After first couple rounds of meeting our $100,000 goal, minimum goal, getting our feet underneath us, we've really seen the interest start to increase. So we've had 3 consecutive sold out raises, which means we've received more than our maximum goal of $250,000, in which case we go to the largest investors and we trim down their investment. So we make sure that we're protecting the smaller investors that we're really trying to target with these offerings. You can see in the past year with interest rate environment, increasing interest rates, we've maintained a positive spread between what we're offering to our investors versus the loans that we are purchasing from the SBA program. So if you look on that far right column, you'll see the interest rate of the tranche of SBA loans that we purchased in the most recent tranche before each issuance. So you can see we're maintaining a positive spread between 1% and 2% between what we're paying for the SBA loans versus what we're offering to Green Liberty note investors. So even though the interest that we're offering has been rising, we're still in a positive position there. So I wanted to highlight that for the board. You can go ahead and go to our next slide. Awesome. Yeah, so we've now reached more than halfway to that $2 million goal, having received more than $1 million of investment. And interest continues to grow in this program. The latest issuance was sold out or reached that $250,000 marker in just 5 days. And that means a lot of folks weren't able to take part in it, which means we have a growing wait list of a bunch of folks who are going to be notified as soon as the next issuance come live, so they can get in this time. So we're really excited to see the kind of continued interest from investors. In terms of total investments, we've had 291 investors so far. They've made 420 investments, with well over half of those investments coming from Connecticut residents, well over half coming in increments of $1,000 or less. So we're really kind of hitting our key demographics there. And in terms of kind of recent developments, that first round investors, their investment came due after a year in this January. In addition to offering them their repayment, we also offer them the opportunity, if they wanted, to take their principal and the interest that they've earned and reinvest it into the next round. As far as we know, we are the very first issuer to offer this through regulation crowdfunding. So again, being innovative, and it was wildly successful. More than half of those first round investors took part, saw a lot of excitement there. So that was great. And we were able to successfully repay those first round investors. And we are continuing to work hard with Raise Green as a partner to make the investor experience even easier. We're working with them for folks to be able to keep their address and their bank information in Raise Green sites. So we can take away one of the third parties that we've been using and just make the investor experience even more streamlined. With that, I'll go to the next slide. So, as I said, we've been building momentum here, and that's shown in some great earned media we received. Really cool Washington Post op-ed. That was a great deep dive into our Green Liberty notes and Green Liberty bonds. There's also an article in The Ascent, which is from Motley Fool. Again, some other kind of earned free media. Really great to see, and we expect the benefits of these 2 articles to really show up as we go to go back to the market likely in April here around Earth Day with the next issuance. That is all for me. I'd love to hear from the board just any thoughts they've had on the success of the program. And not too long, we love to expand the program and continue past that 2-year mark. So I wanted to just open up and see if I guess I should pass that to Chairman Reed who does that. But thanks for giving me the opportunity here to give you an update.
Thanks, David. And actually, and I'll throw it open to everybody else, but I've had some, as we all have, several conversations with from some financial folks, and they're saying, what do our interest rates look like going forward? You know, this incredible concern over what's happening out there in the global economy, and I'm just wondering if there's any sense of it or what.
Well, I'll take that, Chair Reed.
Okay, thank you.
Yeah, well, market conditions are volatile, as I mentioned earlier in the meeting, and you know, what's interesting is because there's quite disagreement by in the financial markets themselves as to whether, you know, the Fed will sustain its path of increases in interest rates or decide to pause or in fact maybe even cut rates. You know, there are expectations that if you look at the 2-year yield, which is now just around 4%, that actually rates will be cut. So and that rate has fallen by about 100 basis points in the past 10 days. So it's really incredible moves in the marketplace. It's bouncing around, you know, 20, 25 basis points a day. Very unusual market conditions, but it all relates to the Silicon Valley Bank, Signature Bank, you know, takeovers, seizures by the FDIC, concerns about First Republic, which actually was given a $30 billion deposit contribution by several of the Wall Street banks yesterday or announced yesterday. So it was a vote of confidence. So it's unclear where the path of interest rates will take us. But I think one thing that was pointed out on the chart as far as our relationship with the loan purchases is we are keeping that delta, that positive relationship, meaning we're not losing any money by or whether we increase or decrease rates. It's following the path of rates in the market generally. So if I had to guess, I would say that the rate that comes up in April is probably going to be a bit less than the last time, just based on current market conditions, but that's subject to change.
Thank you. And I guess are we at all insulated by our full faith and credit of the state component?
Well, these notes are not scarf backed.
Oh, that's right. Okay, forgot.
These are not scarf backed, but they are backed by a multiple of cash flow. So we covenant that at least there'll be a 2 times coverage of whatever the debt service is that is required to be paid under the notes, will be covered by 200%, twice the amount of amount of debt service. So if we have to pay out $100,000 in debt service, just pick a number, we assure everybody that we'll have at least $200,000 of cash flow to pay that. So everyone can rest assured that we're going to have enough cash to pay off these notes. And in fact, the ratio is even higher than that, but that's the minimum requirement that we covenant to.
Okay, thank you. Any other questions? Well, if unless people want to hang around all day, I think it's time to adjourn. So do I hear a motion to adjourn?
So moved.
A second?
Second.
Thank you. All in favor?
Aye, aye, aye.
Aye, aye, aye.
Have a nice weekend, everyone.
Have a great weekend.
Take care, folks.
Thanks,
Bye-bye.
everybody. Thanks for hanging with us.
So long.